Twitter. I'm trying this out. I told Kevin he's kind of my guinea pig here. And everybody, this is Kevin Muir, the famous Kevin Muir of the MacroTourist and the Market Huddle podcast. How are you?
It's great to be with you today, Brent. It's nice to be on the other side of the interview kind of microphone.
Yeah, I was super excited about this because I've listened to more hours of your podcast probably than I should admit. Days of my life have been dedicated to the Market Huddle. And what's kind of neat, and I wanted to sort of bring this up to start, is that my big break, I guess I would say, just January of 2020, it was the Market Huddle podcast in January of 2020. And we talked about market gamma and how that affects markets and all these different things. And at the time, it was about like convincing people that the options flow had an impact on markets, right? And now that's just sort of like everyone takes that kind of for granted in a way, right? After meme mania and all that, it's really been. So sorry, I just got distracted. Someone said they can't hear me, but then they said my bad. So no problem, Travis. Sorry about that. But anyways, it's been interesting 2 years. I started listening to this, and a lot of the things we talk about now again are commonplace. Is really pretty interesting. So I owe you a debt of gratitude for that. Well,
it was my pleasure, Brent, and thank you for the kind words. But you were actually we owe you the thanks because you've taught us a lot of things. And I know when I started to figure out how much these options were moving, and I kind of looked around and said, "Who's doing this?" And someone gave me your name, and I reached out. And it's been a pleasure having you on the show, and I've learned a lot from you. So I really appreciate it. What's funny is that a lot of these things that you have highlighted and talk about, like the Vanna effect and the charm effect. I used to do them so for those who don't know, I used to be an index derivatives trader at a Canadian bank way back when. And we kind of did those things, but our positions were never big enough that they never changed any of the underlying markets. Right. So for example, charm on the long weekend or even on a regular weekend, Friday at lunch, I remember us on our models, we put it out to Saturday. So we would go and we knew that, we were about to hit a weekend effect and that we had to move the kind of our model out a day. And the thing is our positions were small. So maybe our deltas changed a little bit. And it was a real wake up call for me when I realized that the position sizes in these options were so large that they were actually affecting the underlying markets. And it's been a fascinating just kind of journey that I've gone on and learning about how all these things that I used to do are actually, when they become big enough, are more of a function of the tail wagging the dog, and that's really what we saw. And just when I was trading back in the old days in the 90s, there was some big positions in New York and Chicago, but not like now. Like the option whale, I wrote a piece for my newsletter, Brent, and I was trying to do some math. And I couldn't get the things to get down to I kept getting $1 million error. And I was like, what the heck's going on here? Why is this? I'm off by $1 million. And then I realized the rounding errors on these positions were so large that I was getting $1 million errors. And I sat down and thought about the size of this position. And it's unbelievable. I'm at a loss for words at how much this has affected it. And then obviously, you were at a perfect spot in terms of 2020 and 2021 with the Tesla and all those things. So anyways, thank you for the kind words, but I want to thank you for helping me understand all this.
Yeah, I mean, it's also a lesson in marketing, I think, because you talk about a lot of the flows like time decay and implied vol drops and your buy feature, whatever it is. And then these marketing terms, I call them, there's this second order Greeks, Vanna and charm, whatever, but it never assigned just that label, which just sort of locked in exactly what those flows were. And I think that those were a big bridge to people understanding, because you didn't have to bumble out 3 sentences as to what this was. It's sort of like Vanna. Oh, okay, now I know what they're talking about. It's
well, the other thing that I think is interesting is that I'm much older than you and I've been around, but it shows you how the market's always changing and how you always need to be adapting and learning. And that's one of the things that I love about this industry and about what we do. We're extremely lucky that we have something that is intellectually stimulating on a regular basis. And it's just when you think you know it all, you're destined to fail, because there's always something new and there's always something out there to learn.
Amen. And I you might be a little bit older than me, but I'm feeling pretty old myself. And if you've been around this long enough, you know that, you got to stay humble, because
Yeah.
the smartest guys in the room will blow up. Markets change, themes change, and that is a lesson that is, as old as time. And so to that kind of point, a lot of people have been talking about, is the options market as impactful here? And so I've been trying to learn about as much as the macro space as I can. I've been calling myself a macro tourist, basically, somewhat, I've gotten that term off of your show. Basically, I come in here and I chat about the macro market because there's so much happening there. So many questions come in, and a lot of what's happening in the options market, like the CPI print today, is triggered by whatever happens from, the macro piece, right? So this was a high print CPI print. What's vol going to do off of that, et cetera? So I have to have, I'm trying to learn again in line here, but this is a complicated macro market to, assess, right? I mean, you listen to 50 different podcasts and everyone's got a different theme. And my feeling, and you're probably going to feel worse about your stance in this, but I feel a little bit like you, if I had this right, that you feel like in general, we're at peak hawkishness, even with the CPI printed ad. I just sort of felt like people overshoot their expectations. Is that kind of the way that you've been thinking about it? I mean, that was one of your pieces recently, I believe.
For sure. I completely think that today, going into the CPI today, I wrote something last night that said something to the effect that one of the smartest fellows that I know said to me, you probably buy the CPI print regardless. And his thinking was that if we end up having a weak inflation number, well, there it is. Inflation is kind of peaked, so you can buy it safely there. And if we end up having a strong inflation number, it'll probably be the last one. And the reason is that if you look at the yield curve, if you look at inflation break-evens, if you look at what commodities have done, there's a wide array of different indicators that are showing that basically peak inflation is behind us. And it was just a function of the market is so scared about the Fed because the Fed has gone in there and has made a mistake in that they waited too long to hike. And now that they're hiking, we're worried about them creating an error the other way. And that same fellow that I was speaking to, we were kind of lamenting how confusing and how many cross currents there are about this market.
Right.
And we both agreed, and he's even older than me and much more successful. He said this is the most difficult macro setup I've ever seen in terms of all the different pieces. And, we think about inflation, and we'll talk about inflation is just had its peak, and yet inflation break-evens or inflation swaps that people trade have already been going down for the past, 3 months? They peaked in March or in April when finally Jay Powell pivoted. So we have everyone, hyperventilating about the latest print is 9/1, where the market has already gone ahead and discounted the fact that inflation is going to come down. And so it ends up being this kind of delicate dance that you need to do in terms of trying to understand what's in the market, what are they expecting, what's going to happen, and then as the data comes in, how does that affect it? And it's more confusing because there's different parts of it. So yes, today was a terrible number. It blew the doors off in terms of inflation. And yet, if you look at it, bonds are up. And we had this, the US dollar's down, and all the things that you wouldn't have expected if it really was if it was as bad as everyone thought are occurring. And so that leads me to believe that there's a good chance that we're getting close to the point where all of the worst is priced in, and we're at a situation where if we look forward to the next CPI and we think about the base order effects and we think about what's happened to all these commodities, the chances are that inflation is going to come in. And the market is looking forward through that and thinking, okay, that's what's going to happen. And I think that's why we're seeing the response that we're seeing.
Yeah, and to your point here, that this is the 10-year on the screen, and that has come down a little bit. And I guess from the macro perspective too, the talk of the town, right, is are we sort of just passing higher rate hikes into a recession, and how are things shifting? I know you are in Canada, so you have probably a clearer view of what's going on down here in America than someone sort of sitting in the fire, so to speak. And are you in that camp that, look, we're going to be heading into a recession, and so while maybe inflation expectations comes down, that doesn't necessarily mean that we rally, because look, recession is going to start, the recession vibes are going to start increasing.
Yeah, so I am definitely not in the recession camp. I do believe we're going to go through a slowdown, and we've already priced that in. I think if you look at a lot of things like small cap stocks and the shape of the yield curve, it's pretty clear to me that a slowdown or even a mild recession is priced in. And the reason I don't think that we're going to get that recession and what people are missing is basically the same thing that they missed coming up to this point, Brent. And I think we should maybe take a step back and think about how we got ourselves into this situation. If you think back to the great financial crisis, we had this collapse because there was too much borrowing, and then they cut rates to zero. When they got cut rates to zero, they found that they did quantitative easing because they needed to stimulate, and the quantitative easing didn't work, even though a lot of people were worried about it working. And there was this kind of belief that the Fed was acting irresponsible and was about to create this inflation. And then lo and behold, we go 3 or 4 years and nothing happens. We don't get inflation. We get one of the weakest recoveries on record, and everyone's confused by it. And the reason that occurred was because there was very little fiscal stimulus. And in fact, there was there was a little bit of the fiscal stimulus at the beginning with the cash for clunkers. But the reality is that after that, we had the sequestration, we had the Tea Party movement. They were cutting everything on Obama. And so we actually had a situation where we had tight fiscal and easy monetary. And we then fooled ourselves into believing that we could do all this and we couldn't make inflation. And for those who have been following me for a long time, Brent, I've been a huge inflation bull for a long, long time. And my argument has always been that, yes, things like the amount of debt out there and things like disinflation due to demographics and things like technology, those are all factors that make inflation either easier or harder to create. But at the end of the day, if the government wants to spend the money into existence, they can always make inflation. And we had forgotten that. And then COVID hits, and guess what? We do it, we spend, and lo and behold, we get this monster inflation. What's funny now is that people are forgetting that why we have such a strong economy is because we've gone and put money into people's jeans. And so what they're doing is they're looking at the current rate rises, and they're saying this is going to look just like 2015 when we tried to raise rate, or when Europe tried to raise rates and thing rolled over, or whenever it was, 2013, when the economy was very slow to get going and easy to stop. And the reason I think that this time is different is because of that fiscal. And we look at what's happened to people's balance sheets, and there's just so much more money in people's balance sheets. And so we have people with the ability to spend, whereas they never could spend before. Like during the great financial crisis, people were underwater on their homes. They were getting lower rates, but that didn't help them. They still, had to make the bills and things of that nature. In this case, it's the other way. We've gone and we've put money into people's jeans. Their balance sheets have never looked better. And yes, no doubt about it, the higher rates are going to bite. But the thing about it is that they're going to go the moment that slows down, the moment we get this kind of Fed scare just to pause. I think that the consumer comes roaring back because their balance sheets are perfect, or not perfect. They're as best as they've ever been. And what we're going to find is that the private sector credit creation, something that we have dismissed as no longer able to happen. Like ever since the great financial crisis, we've had to rely on kind of fiscal stimulus to get the economy going. But now we have a situation where the private sector credit creation could actually start again. And this is one of the things that I think we're going to be surprised about, is that banks are going to lend, people are going to borrow, people are going to buy homes. And I think we're going to be shocked at how resilient the economy is. And so, no, I don't think that this is something where you're going to see the economy roll over just because the Fed's raised, 300 basis points.
Those are a lot of great points. And, that direct stimulus, I think, was so impactful in a way. And in a way, it almost proves a theory, right? They have a different tool in their pocket where those direct cash payments stimulated things in a way that, just didn't happen in the financial crisis. And I mean, down here at least, and everything's anecdotal evidence, but the economy's humming. I'm in Connecticut, and restaurants are packed, and you can't get anyone to do like
Yeah.
odd jobs and things like that. And it's so those are all real small pieces, right? And I think a lot of people are watching the housing market. And to your point, like maybe it just cools things off a little bit. And I know inventories are building in some different things like that, but you don't get the feeling that that there's a big economic crash pending. Some data, I guess, shows that. To one of your points, housing, which in Canada is a different animal, I think, in terms of the prices than here. You, I believe, had mentioned about getting long housing stocks. Obviously, this is the key barometer of how markets are doing and how consumers just feel about themselves, right? What's the value of their house, which I think a lot of data says that that's where a lot of people's assets are tied up, right? Do you like the housing sector still? Is that, I don't know, how I think small caps is another space you were looking at before in one of your recent notes, and what are your sort of stances on that?
So I still like the housing. I believe my buddy Harris Kupperman, he says that everybody has PSTD from the
Mm-hmm.
great financial crisis.
Mm-hmm.
And everyone's assuming that the housing slowdown is going to look just like the GFC. And there's all sorts
Right.
of arguments for that. And there's people out there talking about the amount of borrowing. And listen, the banks are in great shape. They're not allowed to go and do what they used to do, and the reality is that there's this huge demographic kind of tailwind at our back with the millennials going out and buying houses. And sure, it's gotten to the point where it's slowed down, and the Fed's trying to take some steam out of it. But I think that's all in the price of housing stocks at this point. And when I look at the moment that the Fed stops and just slows down and gets to a point where they can just pause, I think that they're going to take off again. I think it's a great area, and you just mentioned it. People still have jobs, and ultimately,
Yeah.
that's what really, really hurts the economy and creates a recession. And until I see people losing jobs in a meaningful way, I'm not worried about a slowdown. I think it's going to be an opportunity for the Fed to pull back a little and not be as hawkish, because that's really the only bad thing out there right now is the Fed. Like, in essence, like, to me, you can explain all the bad things that are happening in this economy is that the Fed is worried about inflation, and rightfully so. It's 9% or whatever. But the moment that comes back, and the moment we get a situation where they can just get neutral, I think that a lot of the positives will come out again, and we're going to be off to the races. And I suspect that before this is through, the Fed is going to be tightening again more than the market expects. And right
Right.
now, what is there, 100 basis points of easing in for 2024? I'll take the other side of that trade. Like, I don't think that's going to be the case. I think we're going to be shocked at how resilient the economy is, and how it doesn't get crushed nearly as bad as everyone thinks. Now, I just want to say one thing. People confuse the economy with the stock market,
Mm-hmm.
and they're two different things. They're not the same thing. And also, when I talk about layoffs, I talk about like mid-America and the majority of kind of America working class. But don't get me wrong, I have been kind of a tech dream stock / ARC / technology in general bear for some time now. And I think that those stocks were priced for perfection. They were over-owned, and that the bear market they've entered is going to be a long, protracted affair, and that there will be continued layoffs in those sectors going forward. There was a huge rally, and this kind of a blow off top almost, because it was a perfect environment, the COVID thing. Everyone was using computers, everyone was using all these products, and they're going to just be for sale forever. And I think like Peloton's a perfect example. Peloton, they thought that this thing was the second coming. It was going to be terrific. It was going to rule the world, and
That's a
they
painful
priced
chart.
everything. And like, it's just for sale, and it's going to be for sale for a long time. Yeah. Are there going to be rallies? Sure. But is that company going to be forced to get smaller and smaller? Probably.
Yeah, those are all great. I mean, it is a deleveraging to to that point, and I think that's been seen nowhere more than in crypto. And the deflation, I think, of a lot of these things that were clearly bubbles has gone remarkably well, I think. I mean, there really has not been credit stress, certainly nothing like March of 2020, the great financial crisis, where you had industries going belly up. And I think that was what added a lot of volatility to the markets. It's been a pretty, I mean, at least in the equity space, it's been a pretty smooth ride down. Some of the bonds, I think, have reacted quite a bit more violently. And then you add in a little bit of the obviously the global, the wars and the things like that have added a little bit extra stress, but really it is going pretty smoothly, I guess. Even though it is going lower, it's not been violent. One thing that we look at a lot, and I'd like to get your take on, I've put out in the past, this is the MOVE index. And so this is essentially the at the money volatility for treasury bonds. And my MacroTourist view is that, look, when this comes down, this is telling me that the bond market is feeling a lot better. And that is going to be a big signal for equities to resume a rise. Do you have any view on this? If you were to sort of have one indicator in your pocket to measure sort of that credit bond stress and a signal for equities, I mean, how do you think about that?
So I think that the MOVE index is very important. I loved your piece that you did the other day, your video about it. I thought it was really interesting. It was a great way of thinking about it. It's difficult for the MOVE index to come in with there being so much volatility around Fed policy. Mm-hmm. And when you're getting Fed rate hikes of 50, 75, 100, it's very, very tough for it to happen. So I think what we're going to need to see is for the underlying economic conditions to just ease out. I mean, to flatten out a little before we're going to be able to get kind of some stabilization in the MOVE index. I do think it's interesting, though, that this rise in the MOVE has occurred, and yet the VIX and the stock market index volatility has been relatively well contained. And one of the things that I've been talking about for a long time is that in the past, before the COVID, everyone always put bonds into their portfolio as a ballast to their stocks.
Yes.
And if you think about it, it's been a terrific trade. Guys like Ray Dalio have made their fortunes on the risk parity, the idea that you can lever up a stock portfolio with bonds, because when stocks are doing worse, the bonds are going to be doing well. And in this meantime, we've had this, 40-year move that's from 15 down to basically 50 basis points. It's been an absolutely unbelievable trade, but this has all occurred in a period of disinflation. And if you look over a longer period and you go back 100 years, you'll see that during periods of inflation, bonds and stocks are actually positively correlated instead of being negatively correlated. And my line that I always said was that be careful about assuming that the bonds will be a ballast in your portfolio. I think they could be the anchor that drags them down. And we just saw the first worst 6 months of the bond market since like the 1800s or something. It was some crazy number. And so do I think that bonds are going to continue to, suck so bad? I don't know, Brent, but I do think that those are expecting them to be a top performer, and that idea about using it as a ballast is probably gone. And that you should be careful about, mixing stock and bond portfolios, because I think that there's a potential that eventually it gets worse. But in the meantime, I suspect that what we'll do is we'll get a bounce, we'll get a flattening of the bond market. MOVE will come down, and you're probably right. That'll probably be the signal that causes stocks to go bid again. But listen, it's a tough environment because it's like we could have a situation where the long end of the bond market, and this is what I'm really worried about, because so far the long end of the bond market has been really quite contained and quite, let's just say, accepting that the Fed will control inflation. But what happens if the Fed rises rates to, let's say 4%, they go sideways, and then all of a sudden inflation doesn't come in? What's the fair price of the 10-year? What's the fair price of the 30-year? And right now the curve's inverting and everyone's rushing out because they're all assuming the market rolls over. And I'm kind of nervous about that. I'm nervous that we could get a situation where the curve goes back and steepens, and it steepens because the economy is stronger than everyone thinks. And inflation actually is a longer term, bigger problem than people expect. And then in that environment, what do you do? What do you own? It's difficult. And I would probably say that you own value stocks, you own real economy stocks, you stop buying long duration assets that have benefited from the lowest rates ever. And I would argue that that's what those, those top 8 technology stocks, like all the FANG mats were. They were basically, you were trading interest rates. You were buying an asset with the longest duration, and you were running out and doing it, and it had the tech tailwind at its back. And that's what I'm really worried about when I think about the stock market. And one of the things that I counsel everyone is, they all talk about the stock market as one big glob that go up or down. And yes, for a long time that was the case. I think that we're going to start to get more and more differentiation. And I know everyone hates it when you say it's a stock pickers market, and I don't like the guys that go on CNBC and say it's a stock pickers market.
Lost art.
I think that's crap too. But I would say that the ability for people to make money within the stock market has never been higher. Mm-hmm. I think that we're going to look back at this period and say, oh, there was some real opportunities to make a difference to your portfolio by having it kind of structured in a different way.
Yeah, those are a set of really insightful points. I would just say that I like what you're saying, because it's different than a lot of the other macro commentary that I hear. And like I said, I've been listening to a lot of it lately, so I love the different angle. To your point about how do you look at the yield curve and things like that, I've been wondering, you look over at Europe, and they're in some trouble, from my perspective, just with the energy mess and some of the other things going on there. And, is Asia doing okay? I'm not really qualified to mention that, but I do think there's still a situation where do assets just flow into the US because it is still the most stable, country out there. And also another thing while I'm on that topic is, if you are, a pension fund, or you're a big owner of bonds, right? And you know that interest rates are going to keep going higher here. Where are you allocating, right? To your point about Ray Dalio, they had a 30% return this year. I think they have a little bit more than the 60-40 risk period portfolio, but, have a lot of flows been turning into equities, even though the equity performance has been bad, just as the fact that that bonds are going to go down because those yields are going higher. Is that rotation kind of benefiting and holding up the markets here in a way, that, okay, yeah, the trade hasn't kicked in yet, but could that turn into a real tailwind for equities?
Oh, I 100% think so. If you think about inflation is a long bond investor's worst nightmare. They assuming no default, Brent, the worst thing that you could have as a long bond investor is a decade of 5% inflation.
Yeah.
So what are you going to do if you don't own it? I guess you could own some gold. You could figure out some commodities and things like that. But value stocks, if you go look over 100 years, you'll see that small cap value has outperformed almost every other. Well, actually, all the other groups or the factors. And I suspect that what's going to happen is that we're going to have the decade of small cap value and even large cap value outperforming. Like the real economy stocks are gonna do well again. And just the other thing I just want to mention, you talked about the fact that a lot of the other macro people are talking about, let's just say things that are a lot more dark and pessimistic.
Right.
And I saw recently the Bank of America had a sentiment gauge amongst their institutional clients, and it hit 0. It's like it was like 0 to 100, and it hit 0. So yeah, it's not like I don't understand their arguments of these people that tell me that this is going to happen, that the milkshake theory is going to cause the US dollar to go up, and that this and this and this and this. But like a lot of these things are like they're in the market, and our goal is always to ask ourselves, what's the right bet? And is the right bet to go along with everyone else and to assume that this is going to be as bad as everyone, believes? And then what are you going to get paid for that? And, I always kind of say, if you think about it like as a football analogy. You could be a hotshot guy and say there'll be a team that's favored, and it'll be heavily favored, and you go and you bet it, and you think the whoever's going to win. Let's just say the Rams are going to win the football game, and you look like a hero because you called it. But if you're looking at what your risk reward payoff is, and over time, if that trade's not going to happen enough for you to get paid, and you're going to find that you lose money, great. You've successfully called it. It doesn't mean it's the right trade. And I think this is what a lot of people miss, is that you can talk about things like, for example, inflation is a great one, Brent. If you wanted to go, you could say, I called the inflation. I thought that this was going to be great. Well, the reality is, over the last 3 months, that unless you were in a very specific type of inflation swap that you were receiving only these 3 months, if you had any sorts of duration on your inflation swap, you actually lost money. All the inflation trades have come down. So great, you've called these higher prints, but you're not trading those prints. Almost nobody is trading just those one prints. They're trading what the market expects future inflation to be. And I think that's the part that that I try to emphasize. And one of the things that I'll say is that I always say the hardest trades are often the best trades, meaning those ones where you get up and you just feel sick because it's like everyone's telling you exactly the opposite thing, and you're like, oh God, and you feel like an idiot. And I'll give you an example, Brent. I went and we had Marco Papich on our show, the Market Huddle, and he came out and he put into words something that I was thinking about, that I wanted to do, but he actually came out and said it. He said, I'm going short oil. And this was 2 months ago, when everyone was super bullish, when everyone was falling all over themselves, talking about the bulls and stuff. And I was worried about it because it was so bullish, and I didn't have the guts to write the piece, because I wanted to write the piece and I was too scared because it was too hard. Right. And he did it. And I'll say those trades, those ones that make you feel sick when you're all alone, those are the best trades. And they're so hard and they're so difficult, and you feel so lonely and you feel like such a fool. But often those are the best ones. And those are the ones that, because if you think about it, if everyone agrees with you, it's not a good trade because it's already in the market.
100%, right. It's kind of like just buying equities here. You probably feel sick today doing it. And no more is that kind of crowded trade, more obvious than the options market. I mean, there are people who buy calls paying implied vols that are absurdly high, and stocks continue to go up, and they end up losing money anyways, because it's like they bet wrong in the second or third dimension.
Right.
So that's a great point. The other thing that's funny about the oil, rise was that I was looking at insider trades on a lot of the energy companies, and it's almost 100% selling. I think Warren Buffett is buying Oxy, I think, but outside of that, all these oil insiders were all selling, and it was an overwhelming sell, which obviously in hindsight is a very clear signal that things are going down. But it's if they're not buying, then they probably know something, right? It's like they're all happy to get that tick up to kind of unload.
Yeah.
That is just kind of trading 101. The blood in the streets analogies or whatever it may be,
but it's so easy to say and so hard to do, and it's so hard. And people always say, I'm gonna day trade. I'm gonna paper trade, and what's one of those things, Brent? You can paper trade all you want, but until you got the money on the line, until you start feeling the pain, until you start experiencing all those emotions, you can't do it. And it is very, very, it's very tough to not get caught up in that mindset. And like, I would argue that we experienced one of the greatest bubbles of my lifetime with the whole ARK / Bitcoin / meme stocks. And I never thought I would see a bubble of that proportion, and the fact that people would openly say it's a Ponzi scheme, and that was literally a bullish argument, was just beyond me. And I don't think I'm ever going to see another one as quite as crazy and as manic as that. And I think that I always told people during it last year, I said, timestamp this in your mind. This is an historic bubble that you will talk about with your grandkids for years and years to come.
Yeah. You know what's interesting on that topic? I'm glad you brought that up, because the crypto, it's been a crypto wipeout now, right? I mean, anything that was pure garbage went to zero. Bitcoin and Ethereum are still holding up. And despite that loss, right, it didn't really bleed over into any other, kind of traditional TradFi assets, right?
Yeah.
And if you were going to tell me there was going to be $1 trillion lost, right, that it would create a little bit more chaos, just sort of in financial systems, writ large, right? It's really been pretty well contained.
So I agree with you. And I've been a big crypto skeptic for a long time. I was actually lucky enough to get it on the short side and make a little bit of money on it. But one of the things that that it makes me sad, because I know a lot of people had their lives ruined on it. And it actually kind of frustrates me that the government wasn't doing a better job of getting ahead and making it so that a lot of these frauds weren't actually allowed to perpetuate and steal people's money.
Right.
But one of the things is that as I was trying to understand it, I kept saying and asking everyone I knew that was into the weeds. I said, what's the leverage like in the system? I kept saying that. What's the leverage like? And I couldn't figure out where the leverage was. I couldn't quite understand it. I would listen to them talk about their market making things for these things. And, although I was originally, I bought Bitcoin, or I traded Bitcoin and mined Bitcoin when it was literally $50. I had long since retired from it, and I didn't keep up with it. So I didn't understand all these other ancillary kind of shit coins, as they call them, and things like that. So I didn't understand where it was, but when they explained it to me, it just sounded like such horse shit. I was like, oh no, that's probably where it is. And I've been worried, exactly like what you said, was that I've been worried that would bleed into the main system. And I too have been surprised at how contained it has been. And I guess that just shows you that there's very little overlap, that there was no things. And that it really, the other thing I will say is that I'm actually surprised we're at 20,000 still, given all the bad news that we have. And so I've been short Bitcoin for, I don't know, like 6 months or something in my letter. I covered it last week. And the reason was, I was like, I don't know how much more bad news can come out on this thing.
Yeah.
Like, you have literally, guys, whole exchanges going down, all these things. And to me, it just felt like, okay, this thing is not going down anymore. And there's just a plethora of bad news coming out on it. In terms of why that didn't kind of bleed into the finance, I would just think that it's two separate communities. And the only other thing I will say to you is that, yes, what was the market cap of all crypto? 3 trillion.
Yep.
So, but I think that's kind of a made up number. And this is why I'm going to say to you, if you and I, let's say you and I float a coin.
Good point.
Right? And we float a coin and we sell, let's say it's got $100 million market cap, but we float, $500,000 of it. Well, theoretically, that has, $100 million of market cap added to the actual total market cap. But we all know that it's just this $500,000 little token amount that's trading. And I think that was what happened. We had a lot of these kind of shit coins get created. The majority of it was sitting in like somebody's bank account. It was just a small sliver that was trading. So it ended up looking like a lot more than it was. So I don't think it's as big a deal as everyone thinks. Having said that, this whole thing about the tether, and maybe I'll rue this, maybe it'll get a lot worse. It might not be, the story might not be over, but I do think that for those that are pushing too hard on the short side down here, you're probably overstaying your welcome. And I could easily see a nice bounce back to 30,000 or something.
Yeah, I agree with you on that. And my main reasoning is that, and I brought up this long-term chart of the Qs because I just feel like this is the internet bubble, right? There's some good ideas there. There's a lot of very smart people dedicating their lives to building stuff out here. big companies want to get involved. I mean, we're constantly still getting questions. Are you getting involved with crypto? I think a lot of people view it as innovation, right? And that's the next sort of leg for finance to get into. So I think that this was a good cleansing of the system, a la, pets.com blowing up in 2000, right? And it's stabilizing as a whole for the market, right? You had to get that leverage out of the system. You had to get the nonsense out of the system. And I think that makes it, better. It's sort of like when a forest burns a little bit, comes back stronger, right?
Yeah.
As long as it doesn't burn down too much, God forbid.
Can I just I'll just to agree with you
do.
there. Amazon, which ended up owning the internet, a terrific company. It was supposed to change the whole world, change the way the stuff gets delivered in 1999. 1999, it rose and then it fell 95%.
Yeah.
Right. And that's the thing, is that it ends up being that we could very well, maybe you guys are right, maybe crypto ends up ruling the world, but that doesn't mean in the meantime that we don't have an Amazon type drawdown.
Yeah. And I don't feel the same way about ARK, for the record. I don't think all things bounce back, but
yeah. Listen, I'm with you too. Listen, I'm a Canadian, and we had Nortel that just it had its its rise, and then it fell, and then it just went into zero. And I suspect that that's the case there. But anyways,
there was a great chart going around about what the world's biggest internet sites were over like 1990s today, and it was AOL and Yahoo, and I forget the third one, but it's amazing because those are all completely gone now, and the top are Google, YouTube, Twitter, and I think Instagram or something like that. So these things that didn't exist, and you kind of wonder, is like that's kind of what's going to happen to crypto. Like the killer app maybe finally comes out, and that that ends up being the dominant thing, but maybe it gets built off of Bitcoin or something. I'm not entirely sure. If you're open to it, I'll take a couple questions. You have questions put on YouTube. Amar here asked, what do you think of the 3-month, 30-year flattening curve? Last time it happened was in the great financial crisis.
So as I mentioned, the yield curve has gotten really steep. We've gotten, I think the 210s have inverted. I'm not, it's a 3-month, and everyone always talks about
it's a different swap. I don't have that one loaded up.
Yeah. So everyone talks about the different curves. And I actually wrote a piece about this. It was interesting because the 210 is the one that most people use to signify a recession. Right. And then when I went and looked and found the original paper, I went and dug it up. The original paper actually used the 3-month 10-year. So that was the one that everyone used. And the thing about it, the 3-month, versus 2-year, that's kind of pretty close. So I understand why people gravitated to the 210s. The whole curve is flat. Whether that one's inverted or not is up for debate. And although I always worry about people that don't listen to the signals the market is sending you. Mm-hmm. At the same time, I believe that markets can get things really wrong at times. And I think that ARK is the perfect example.
Yeah.
The market got it wrong. And so everyone thinks that the yield curve is infallible and there's no way that it could ever not produce, a recession from here. I'm not so sure, and I'm not as convinced, given the amount of fiscal that has come into the system, that the long end of the bond market isn't mistakenly assuming that the decline from higher rates is not going to be greater than they think. So in essence, I believe they're assuming that the economy is weaker than it is. Mm-hmm. And so my suspicion is, if there was ever a time to not listen to the yield curve signals, it could be this is the time. And I know, listen, everyone's going to be like, you're an idiot. Like the market's always right, blah, 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 blah. Well, if the market was always right, then there'd be no reason to trade, because it would mean that there's never anything to do. I'm worried about assuming that this time it's going to work as well as it has in the past. And so that's kind of how I feel about the yield curve.
Yeah, and I know that you macro guys get upset when you say yield curve inversion means recession, right? Because those two aren't. I think one of the times most things that gets people very upset.
So the only thing that's really actually being foolproof in terms of calling a recession is this thing called the SOM indicator, and it's a function of I think it's two quarters or 2 months of a greater than X% of change in amount of unemployment, and that's what has been the only thing that has been foolproof. And when you look at that, the SOM indicator, we're nowhere close to recession, because the reality is that we haven't seen any sort of problems or any sort of uptick in the amount of unemployment yet. So I don't know. I really am scared that the long end of the bond market is wrong, and that it should be a lot lower in terms of price and higher in terms of yield.
That's very insightful. Someone here says the Muir is always right, so at least one backer there. And Travis Cross, Travis is a great guy. He asked if you have any feelings about QT, and obviously I think the tightening has just begun, right? Or that's something that's just kind of been implemented in the last few weeks here, right?
Yeah. So great question, Travis. And just for the record, a lot of folks that I respect tell me that quantitative easing shouldn't cause stocks to go up, and quantitative tightening shouldn't cause stocks to go down. And I understand their logic, and I get it, but I'm a seller of their of how it works, of how it works in real life. And I'll tell you why, and I'll just explain to you how that I originally came about this. In the aftermath of the great financial crisis, I was sitting around trading, and I would get these mornings where I would get, like, the stock market looked like it was coming in and it was about to really start to sell off during the day. And then all of a sudden, like at 11 o'clock, we get this bid out of nowhere. And I'd be like, what the hell is this? Like, where did this come from? Like, what's happening? And then eventually I figured out that the quantitative easing was happening on certain days. And those days were the days that the stock market was rallying more. Mm-hmm. And so I started tracking, and sure enough, I made myself a spreadsheet. I figured it out. And there was outperformance on the days that the Fed was buying bonds. And as I wrote about this and explained this, I had someone that reached out to me, and he worked at a hedge fund. And he worked at a hedge fund overseas. And he told me that what would happen is, for his firm, he would see the Bank of Japan do a quantitative easing, meaning that they would go buy bonds, and they would buy it from the Japanese Postal Service, meaning the Postal Service, which is the world's biggest hedge fund or the biggest pension fund, would sell it to them. And then they would invest it with this hedge fund. So they literally saw the money, like they knew it was coming when the quantitative easing occurred. So they would get themselves ready for, oh yeah, look, they just did this. We're going to get X, billion yen or whatever it was.
Right.
And they could see it happening. So I am of belief that the quantitative easing doesn't affect the real economy, but it definitely affects the financial economy. So if I believe the quantitative easing affects the financial economy, I should believe that the quantitative tightening affects the financial economy the other way. However, I think that this one is a little more complicated, because what's happened is there is so much liquidity in the system. They went and it ends up getting complicated with this thing called the Treasury General Account. Mm-hmm. The Treasury General Account was basically the Fed's checking account, but they went and they ran it up, meaning that they pre-borrowed and then they spent it all, they sent it out. And so there's all this liquidity in the system. And there was so much liquidity in the system that in essence, the Federal Reserve got usually what they do in the old days, they would go and they would sell T-bills to the market to go and actually soak up that excess liquidity. In the modern day, what they would do is they would make an interest on excess reserves account, meaning that they would go, and if you had extra reserves as a federal bank, you would just deposit it at the Federal Reserve, at the FOMC or the Federal Reserve, and they would pay you that overnight interest. Well, there was so much of it that they basically, all the banks didn't even want to do it because of the way that the balance sheets worked. And so they had all these clients with all these huge balances. And so what the Federal Reserve was forced to do was make the reverse repo. Mm-hmm. And so what the reverse repo is them, in essence, selling back to the market on an overnight basis or a 1 week basis liquidity to soak up that liquidity. Now, the thing about it is that this number is like literally $2 trillion a night or something. It was some obscene number. And so quantitative tightening, if the Federal Reserve was able to sell exactly what the people doing, or the accounts doing the reverse repo wanted, meaning if they sold them inventory that they could buy, then theoretically we should be able to do $2 trillion of quantitative tightening that would basically just offset the reverse repo. Now, it's not quite that simple, because the reverse repo people are basically money market, and the quantitative tightening people, well, when they sell stuff, they're selling duration. And this is one of the things that I think is another reason you might want to think about fading the idea that we're going to get a flattening of the yield curve, and that maybe the next move is a steepening, because as the quantitative tightening comes out, that's going to be pushing duration into the market, meaning that they're going to have bonds to sell at the longer end of the yield curve.
Mm-hmm.
And we could get a situation where there's a supply on one side and then the other supply the other way. So it's kind of a complicated question. In the past, I would have said it was just as simple. Quantitative tightening means withdrawing liquidity. Withdrawing liquidity means that financial assets go down. Because of reverse repo, I don't believe it's as simple this time, yet I do believe that there's an opportunity in the fact that the different assets that they're selling is different than the reverse repo, meaning that there's a chance that we get a yield curve steepening because of that.
That is an overwhelming answer for me. I read the book by Joseph Wang. I think it's the Central Bank 101 or whatever. So I was able to track that. And again, it's this duration mismatch, I guess, is what the issue is with the.
That's correct.
Right, with the money market funds being the prime user, I guess, of that repo facility, right?
That's right. And then what the Fed's going to be selling is extending. They're going to sell, in essence, not reinvest. So it's almost the same as selling, but technically it's just not reinvesting. But that's going to pull duration out of the market. The other thing that's interesting is that the Fed, in the past, when they were buying mortgage backs, they were helping tamp down volatility. Mm-hmm. Because for those who aren't aware, mortgage-backed securities are short gamma. Because if you think about it, when in an environment where rates are declining, everyone wants to go refinance their house. So what happens is, if you own a pool of mortgage backs, people are paying it back. And in essence, what's occurring is that you are getting your durations going down as rates go down. And then the opposite occurs, less people refinance and your duration goes up as rates go up, which is the exact opposite of what you want. Way back when, before the Federal Reserve owned a whole bunch of those, it used to be that Wall Street would own it and they would hedge that, and it would actually cause selling in the bond market. So you'd see, I remember in my day, we would talk about, we've hit this point, there's going to be a whole bunch of mortgage-backed duration selling. That doesn't occur as much anymore, because the reality is that the Fed owns most of it. But as they own less of that, and as they buy less of that, that's also part of the reason that we've seen an increase in the move. And it's actually means that maybe at the margin, the higher interest rate vol is here to stay.
Right. And as they model those portfolios, the MBS, it gets complicated because the rates are going higher. And the assumption is, I guess, that people are not going to refinance, obviously, now, right? And so really the only reason you're getting mortgages closed is people move and some of those so I guess that's the dynamic there, right? Because that's that short game of trade, right? Because there's a whole bunch of different math involved, because you're kind of estimating what people are going to do and how that is going to affect the amount of bonds in the system there.
Yeah.
I think we'll take one more question. You've been more than generous with your time. Somebody asked here about the dollar. Do you think that the top on the dollar is in? Talk about crowded trades. I mean, I had the chart up of the euro before we were talking about it. Do you have a view on the dollar as a Canadian? I think maybe you do. We'll see.
So I do have a view on the dollar. I have been waiting patiently to short it. And I think it's been a long time since we've talked about the dual deficits. But the reality is that the United States is got a huge trade deficit. It's got a huge current account deficit, and I understand why it's going up. But we have to remember that eventually we're going to get to a point where it's going to affect the real economy. It's gonna slow down US versus the rest of the world. It's going to get to a point where other countries are going to get upset with it, because in essence, what's happened is the US has been exporting inflation to everyone else. It's going to get to a point where the credit, because as the US is the central banker to the world, and as they raise rates, they're withdrawing credit to the world. We're going to get to a point where it starts to cause some blow ups in other parts of the world and in emerging markets. And it's one of these things that it doesn't go on forever. You've rightly pointed out that it is a crowded trade. I do think that I have a really smart friend that has been long the US dollar forever. And I asked him, please tell me when you're going to finally, ring the register, because that might be my signal to go the other way and to short it. And I said, what are the triggers you're looking for? And he said, I'm looking for some bullish reports, because at this point he hadn't actually seen any bullish reports, because everyone was still thinking the US dollar was going to go down. And I think that that's really changed over the last month. I think that I see all of a sudden all sorts of calls for parity, all sorts of calls for 95 cents, 90, 80 cents in the euro. Most people know the story. And we just can't have the dollar going up at this rate without things breaking. And eventually something's going to break, or there's going to be pressure applied to a point where it goes the other way. And ultimately, one of the things that I think is my catalyst from a long-term perspective is, if you think about the last 20 years, well, especially since the great financial crisis, the U.S. has just eaten everyone's lunch, especially when it comes to like a stock market performance. So if you think about it, if you were a European pension plan manager and you weren't overweight U.S. stocks, you're probably fired. Your currency's gone down. You long European stocks, which sort of stunk. And the reality is that every single long-term account out there is overweight US dollars. And it's by the fact that it's been such a great performer. And I've argued for a long time, people say, but how are you going to buy the euro? It's such a disaster. How are people going to buy Brazil or Japan? And I always say, you don't even need them to think those things are going up. You just need them to return to benchmark, because they're so overweight US dollars, because it's been so long. And if we get a situation where those big stocks that I talk about, those top 8, those big kind of FANGMAX stocks, go in a prolonged just for sale, and they just don't get a bid, and they disappoint, we could get long-term money moving out of the US. And I think that's what we're going to find. And I think that's what is going to happen. Right now, money is attracted to the US because rates are going up so much, because the reality is they did the most fiscal. Like America did the most fiscal, so therefore they have the most inflation, but that means they also have the highest rates. But when I think back, think on a longer term basis, and I look at, like, for example, the Japanese, like, you go on a purchasing power parity basis, and it's dirt cheap. And even Europe, I know there's all the bad news. I know that they look like they're screwed on their energy, but what happens tomorrow if there's if Russia and Ukraine stop fighting? Like, think about that. Like, what happens? And yeah, maybe it doesn't happen. I'm not saying it will happen, but I'm just one of the things we always have to remember is ask ourselves, what do I need for this? What do I need to occur for this trade to continue to work? And what do I need for it to, what will hurt me? And I look at these things and I think, well, Europe keeps getting worse. Probably a lot of it's already in the market. Something goes right, it's going to bounce the long way the other way. And so that's how I feel. That's how I feel about the US dollar. I haven't yet really leaned into it. I've started picking away, but I do think that it is one of those trades that you can start to look at. And one last thing, because I know your community is a big option community. A year and a half ago, nobody was buying Move. Nobody was trading options or not nobody, but very few people were getting long volatility in fixed income. It was sleepy. Nothing was happening. The Fed was on hold. I feel like foreign exchange might be at the point where we look back and say, you know what, we should have bought some foreign exchange vol, and that we're going to see that the next kind of exciting area in macro might be foreign exchange.
That's a very insightful and interesting commentary there, because you don't hear much. I mean, now you hear and this is the euro on the chart. It's been just really really ugly. People are starting to watch the yen and some of those other things, and so that's kind of interesting that's actually been, again, fairly stable, I guess, up until recently. With some of the stuff that's going on in energy in Europe, but that is a source or an area certainly of volatility that has not really been talked about that much. That's those are some pretty fascinating insights. This is the chart of the German EWG, which is the German ETF. I mean, this thing is just getting like pummeled, man. It's like really crazy, and very, very strange times over there. So, well, Kevin, we're coming up on the top of the hour here. You've been more than generous with your time. I can't thank you enough. It's been a real treat to actually listen to you and a lot of these this macro commentary that I think is kind of refreshing and different. So kudos to you and thank you, very much for that. Your website. I'm sorry, go ahead.
I said it's my pleasure, and it's great to be with you, Brent, and it's fun to be on the other side of the as I say, to be getting asked the questions instead of asking you the questions.
Yeah, and so you are at Kevin Muir, right, on Twitter?
That's correct.
And your site, the MacroTourist, you have a Substack. You were early in the Substack game, I believe.
Yes, I was actually. I was one of the first, and now it seems to be that it's very popular. It's a great service, and they do a terrific job. And listen, if anyone wants to see some of my letters, just send me an email at kevin@themacrotourist.com, and I'll send you a couple copies of the last few ones.
Yeah, and I will say this: my business partner saw your headshot and thought, "Man, this guy is a true professional. That's a fantastic headshot."
Well, I did.
I actually with an iPhone, and it's all messed up and terrible.
Actually, I got my daughter to do that on vacation one day. I had one nice shirt, and I was like, "Okay, let's go take some pictures," and she did it for me. So she deserves all the kudos.
That is so funny. Well, thank you again. We'll have this video up on YouTube for anyone that wants to catch up with it, and please visit the MacroTourist Substack and Kevin on Twitter. So, Kevin, thank you again. Enjoy the rest of your day.
Thanks, guys. Thank you, Brent. Really appreciate it.